Hello and welcome to this month's Equity Market Review with me, Ritu Vohora. Global equities were on a roller coaster in August as markets flipped between risk-off and risk-on. Tension between North Korea and the US dominated geopolitical news, while at the company level, reported earnings came in strongly across the board. As in previous months, the global index rose in sterling and US dollars, but fell marginally in euros as the currency continued to strengthen. Emerging markets and Asia-Pacific ex-Japan were again the best performing regions, while the UK and Japan lagged. Gold benefited from the risk-off sentiment, with commodities more broadly being supported by a weaker dollar. Oil, though, took a hit from the after effects of the hurricane in Texas and persistent concerns of oversupply. Looking at sectors, utilities and technology led performance. Defensives benefited from the move towards lower bond yields as central banks slowed down the process towards tighter monetary policy. Materials were also strong on the rally in commodity prices. In styles, quality largely outperformed in most regions. In this month's theme, we look at the case for investing in Japanese equities, which is arguably the strongest it's been for many years. As well as being cheap relative to other markets, Japan offers exposure to a combination of strong earnings growth, a favourable policy mix, and plenty of support from domestic growth drivers and an accommodative central bank. The economy is experiencing its longest period of expansion since 2006 and growing significantly above its potential, which, if it persists, will support Japan finally beating deflation. Until recently, though, foreign investor interest has remained low. The tight correlation between the currency and the stock market is a long-standing concern, and as a result, Japanese stocks have lagged other markets since the beginning of 2016. Yet there's been a strong profit growth, with earnings growing at 22% in the second quarter, compared to 13% in Europe. Growing demand has been a key driver, as has improving corporate governance by many companies. Japanese companies are cash-rich, and corporate governance reforms are encouraging the delivery of excess capital to shareholders through share buybacks, dividends, and acquisitions. Looking at valuation, Japanese stocks provide an attractive earnings yield and appear cheap on both an absolute and relative basis. Despite delivering the best earnings growth globally, it has devalued the most. The price to book of the market lags behind that of the US, Europe, and emerging markets. Many investors still remain unconvinced. They worry that the discount is not sufficient to offset the currency and other risks, not least given the current tension in North Korea. But the dividend yield on Japanese stocks is around 2.2%, more than can be achieved from US shares and significantly more than from Japanese 10-year government bonds. Importantly, earnings are rising faster than dividends and buybacks, and this provides scope to improve shareholder returns. On balance, the strength of profits growth, even without the benefit of a weaker yen, demonstrate that companies are growing and performing well. Company fundamentals are ultimately what matters in the long term. Of note, the rise of the Japanese stock market in recent years has been fully backed up by higher profits rather than the significant multiple expansion we've seen in the US. At the macro level, the economy looks robust, and there are anecdotal signs of inflation beginning to come through. The market is pro-cyclical and will benefit if global trade continues to improve and the recent declines in global bond yields and inflation expectations reverse. A strong earnings backdrop, improving corporate governance, and the promise of cash to shareholders should provide abundant opportunities for selective stock pickers. To hear more of our views from across the equities floor, please sign up to our blog, The Equities Forum. That's it from me, and see you next time.